Gold had all the signs and silver of a peak. For all we know, we actually could see gold and silver move lower, build a base, start to rally. And it could be 3 years from now. 3 years, I'd rather take all that money and reinvest it in the stock market. If gold drops down to 3,600, it is going to be a very significant support level. As a long-term investor, this is where you could buy physical metals, park them, put them in storage, and probably wait a long time. I think there's a lot of upside potential from there. So silver it hasn't quite had two patterns play out like gold has for the downside. The silver has got this initial drop right here, and then it has this bounce up, which tells us where the chart is pointing to for lower pricing, which is roughly $39, $40 per ounce. And now the downside for silver is pretty dramatic. Like from where we are as you and I are speaking today, which is May 28th, there's a 46% haircut that could come into silver. What I like about silver is the upside potential. I think it's got potential to go to about 175, which is a very big move.
I would love to talk about the precious metals complex, because you mentioned for gold and silver, you're forecasting a leg lower.
Yeah, so we're getting very close to a potential big pullback in gold. So using Fibonacci, which is one of my favorite tools for getting an idea of where the market is headed, we had this initial sell-off early this year. Then we had this bounce. And you can carry that forward a little bit to see where the downside targets are. So we had the sell-off, and then we had the bounce, and then you hit the 618, and then you have your 100% target. And so we hit that level. And so that move is now done. And so now we have to reset and figure out, okay, well, where is the next chart pattern? Where's the next set of waves? Well, the next wave is this sell-off here, and then we had this bounce. And we'll just carry that forward in future here, and it shows where price should go. We should technically see gold come down to the 618, have some type of pause or bounce, and then come down to the 100% measured move, which is $3,600 for gold. And that'll cause pretty big panic in the market. I think a lot of people in the precious metal space are looking at it as a bullish chart pattern. Anybody who's long metals zooms out and they say, look at this giant bull flag. The next stop is going to be about 8,000, 8,500 for gold. And that's what it could potentially do. If
gold bulls keep celebrating new highs while positioning data quietly signals exhaustion beneath the surface. Chris Vermeulen notes the current Fibonacci structure points toward a potential reset near $3,600 before any sustainable breakout higher. That matters because retail investors usually mistake momentum for safety right before liquidity disappears. If this measured move plays out, emotional buyers who chased headlines could face the exact type of washout institutions wait for before accumulating again. Next, Chris Vermeulen reveals why the bullish supercycle narrative may actually require a violent correction first.
If gold was to turn around here and start to take off, it's heading up to about 8,000 and change. But the pattern on the chart right now is actually pointing to 3,600. And so this to me is going to be an amazing opportunity. I think if it comes down here, this is going to reset the price. So if we were to just draw this line all the way across here, you'll notice down here, this was before gold and silver went into this parabolic move. So really if price comes down here, everybody who chased gold and silver up into the beginning of the year, the euphoric phases when volume really took off, the market has a great way of putting pain on those who made quick, easy money, who chased price on emotion. And so all of those who piled in here are going to have to go through the roller coaster ride, the stock market roller coaster, and probably get shaken out and give up on it, right? And this is where we want to get in. The market has a great way of resetting and coming back to a key level. And then from there could provide a really great opportunity going forward. And then I think we see gold take off for many, many years. So if gold drops down to 3,600, it is going to be a very significant support level. As a long-term investor, this is where you could buy physical metals, park them, put them in storage, and probably wait a long time. I think there's a lot of upside potential from there.
If gold drops 15 to 20% from here, most late cycle buyers will discover they were speculating, not preserving wealth. According to Chris Vermeulen, the real opportunity may emerge only after emotional momentum traders are forced out near major support zones. That completely clashes with the mainstream narrative telling investors to blindly chase every breakout. Long-term savers need to understand that institutional money often waits for panic before scaling into physical assets, while retail usually buys during peak optimism. Next, Chris Vermeulen exposes why volume spikes in metals often signal exhaustion, not strength.
But when we saw this, I mean, we got out of gold right up into this level. When it hit all of our key Fibonacci targets, and I said, listen, this is the blow off euphoric phase. We need to, lock in the gains. We'll be able to reload at a much lower price and then rinse and repeat for the next cycle. So that's what we're doing. We literally exited right near the peak, and now we are just letting the technicals unwind, the sentiment unwind, and it just takes time.
Is this a short opportunity for you, or would you much rather just wait for the long to materialize?
It could be a short. I'm not a big fan of shorting gold. I'd rather just let it drift and fall and just know that the part I'm excited about is picking it up at a much lower price. But there's no doubt it could be a shorting trade. It is big enough to do that. It's about an 18% drop from where we are. So that's pretty substantial. It has crossed my mind because it's a very clean looking pattern that's forming, and there's a lot of downside. But I generally don't bet against gold. I would rather just let it drift and fade down and reaccumulate it later.
What do you think the probabilities are of this occurring versus the other scenario that you outlined, where this is a consolidation pattern for the next leg higher?
Markets rarely ring a bell at the top, but institutional positioning usually starts shifting before retail notices. What Chris Vermeulen is highlighting here is the importance of stepping aside during euphoric phases instead of emotionally defending a trade. An 18% downside move in gold is large enough to damage leveraged portfolios, mining shares, and overexposed retirement accounts simultaneously. Meanwhile, Wall Street continues marketing safe haven narratives while quietly rotating capital into assets with stronger momentum and lower carrying costs. Next, Chris Vermeulen unravels why patience may outperform prediction during this phase of the cycle.
I think it's about a 50-50 coin toss at this point, which is why we're standing on the sidelines. We're just waiting to see if it starts to turn higher and starts to make some higher highs, higher lows on the short-term chart. We can get back in and we can ride it up for the next target. If it drops, we're just going to let the value come back down, and we'll be able to pick it up at fair value or below fair value and get a good deal on it. So again, one of my core beliefs is not wasting time with our capital and not having extra risk and stress when you don't need to. Gold had all the signs and silver of a peak, and we have locked in those, and now we're just letting it do its thing, because for all we know, we actually could see gold and silver move lower, build a base, start to rally. It could be 3 years from now. And 3 years, I'd rather take all that money and reinvest it in the stock market. I'd rather actively invest it into something else that's making me money for 3 years, and then move into gold when it's ready to scream higher for many years, right? So I don't like to have dormant money stuck in a commodity. Gold is an expense. I mean, I used to see my monthly statements for storage. I'm like, oh my gosh, this is, especially as the price of gold and silver skyrocketed, the last storage bill was huge. I was like, this is ridiculous.
The timing gap between narrative and capital flow is where most investors quietly lose years of returns. Chris Vermeulen's argument suggests sitting in dormant metals during extended consolidations may carry more hidden risk than people realize. Storage costs, opportunity costs, and inflation erosion all compound while investors wait for the next explosive move. Meanwhile, institutions constantly rotate capital towards sectors already attracting liquidity instead of emotionally anchoring to past winners. Next, Chris Vermeulen reveals why the smartest money treats gold as a tactical asset, not a permanent identity trade.
Gold costs money to hold. And if it's going sideways for 2, 3, 5, 10 years, that is a huge expense. You'd be better to dump it somewhere else. Even in cash, you'd make money, right? So gold is an expense to carry. And so it better be working, or I don't want to hold it. That's the way I see it.
Perfect. Thank you for taking us long, Chris. What are you seeing for silver? Is it a very similar picture?
It is. It's just more volatile. So silver has got it hasn't quite had two patterns play out like gold has for the downside. The silver has got this initial drop right here, and then it has this bounce up, which tells us where the chart is pointing to for lower pricing, which is roughly $39, $40 per ounce. And that brings us right back into the same time as when gold and silver, gold also took off and went parabolic, where the volume ramped up. The whole world got into gold. I remember being at VRIC as all this was like unfolding. And I remember people talking to people and they say, I've never bought metals before. I just bought, gold and silver. And that is like the signature, right? Of when price is going ballistic. It's on the news every day. Silver felt like it was going up 5% a day every day. And then people just come out of the woodwork because it's shiny and it's moving and they feel like they have to get in. And so everybody kind of got caught in and sucked up and then chewed up and spit out.
When first-time buyers flood into metals after non-stop media coverage, history says the easy money phase is usually ending. This is where Chris Vermeulen's thesis shifts from bullish enthusiasm toward crowd psychology and late cycle speculation. Silver's volatility attracts emotional chasing because rapid gains create the illusion of certainty right before sharp reversals emerge. Retail investors are often told rising prices confirm safety, but parabolic moves typically expose who entered too late once liquidity dries up. Next, Chris Vermeulen exposes why silver's emotional volatility may become the real trap for unprepared investors.
And now the downside for silver is pretty dramatic. Like from where we are as you and I are speaking today, which is May 28th, there's a 46% haircut that could come into silver, which is quite substantial. We exited silver at 111, way up here. So, I mean, like we're talking like it's down about 30 plus percent. What I like about silver is the upside potential. I think it's got potential to go to about 175, which is a very, very big move to the upside, especially if you were to just hold it from where you are right now, say you never got out of silver. I mean, to go to 175, you're looking at about 132% return. But if you were to say, like what we did was what I focus on is trying to get out at major cycle peaks when price is confirming and technical levels are reached, which was about the 111. If you get out of those and you wait for a cycle trough, look at the difference in return if we were to pick it up from here. It goes from making 130% to making about 341%. So you can have these massive dramatic moves if you're actually patient enough and disciplined enough to step aside, let the asset that you love. The problem is people fall in love with metals. You get that. Once you start buying physical metals, it is hard to let them go. I feel very naked and exposed not having physical metals because I've had them for 15 years or so.
Silver doesn't destroy portfolios during crashes. It destroys them during emotional attachment phases. Investors refuse to exit. Chris Vermeulen notes that stepping aside before major cycle reversals can radically change long-term returns, especially in an asset capable of 40% drawdowns. Most retail holders never calculate opportunity costs because they confuse conviction with discipline. Institutions don't marry commodities. They rotate capital aggressively when technical structures weaken and re-enter once panic resets pricing. Next, Chris Vermeulen reveals why emotional loyalty to metals may quietly be the biggest risk in the entire sector.
But if you can be patient enough and actually like break that love affair with precious metals and be like, you know what, I'll either buy it later at a higher price when it's about to go and double and triple again, but it's already on its way, or I might be able to pick it up at a much lower price and make hundreds of % return more. And so that's what I go for. I'm like, I don't want to ride this roller coaster. I don't want to go a year of silver not making a return and watching my profits kind of vanish. I'd much rather just reinvest, pick it up at a value that is, I think, way underpriced. It'll be an emotional sell-off. And then you could, have fairly life-changing moves to the upside, right? Like if you were to catch gold, which will be 100, 150% return, we got silver, which is potentially 300, 400% return. I mean, those are huge moves. And precious metals, if they're 5 or 10% of your account, depending on how aggressive you are in the metal space, that does move the financial needle. That dramatically changes kind of your retirement style, right? It's a big enough play. So that's what I focus on.
When you mentioned that silver is about 33% down from its peak, it made me think of the miners, which are also down slightly less than 30% from its peak, I believe, right now. Are you seeing, again, a similar picture for that, or is it a different technical story?
They're pretty much the same trade. I'm expecting they're going to sell off.
Markets reward patience far more consistently than they reward emotional loyalty to a narrative. According to Chris Vermeulen, waiting for deep emotional sell-offs instead of endlessly holding through volatility can dramatically increase long-term upside exposure. That clashes with the constant never sell your metals messaging pushed across financial media and precious metals marketing channels. A 300% move means nothing if investors emotionally ride a 50% collapse first and lose conviction near the bottom. Next, Chris Vermeulen exposes why miners and metals may be far more correlated than most portfolios assume.
I mean, we could do a really quick downside target, the same as what gold and silver have done. You know, GDXJ, the juniors here are looking at potentially, you know, about another 25% pullback from where they are. And that would bring it back down to kind of very similar spot where everybody started to pile in and move higher. I'm not a big fan of the miners at this point. I think they're going to struggle. I think the stock market could eventually have a very big correction. And of course, miners are stocks. They're stuck in the stock market. And so if the stock market goes down, there's going to be natural selling pressure. So it will help naturally pull metals, miners down. So I think people need to look at this. I think you need to look at gold, silver, and miners. They're all the same trade. Some of them, one of them might peak or trough a little bit sooner or later than the other one. One of them might move 5%, another one might move 20%. They're all the same trade. If one loses, they all lose, right? So that is the biggest thing. I see so many people spread their portfolio out. They're so heavy weighted in gold miners, silver miners, large cap miners, micro cap miners. They got gold and silver and they got leveraged ETFs. I'm like, do you know what you're doing? Like this, all you're doing is just throwing more into the same thing. If you lose on one of those trades, you lose on them all. And that's how I see people, you know, you can make a huge wealth by doing that.
Diversification stops working the moment every position depends on the exact same macro outcome. What Chris Vermeulen is highlighting here is that many precious metals portfolios only appear diversified while actually being one concentrated bet on liquidity and sentiment. Miners, leveraged, ETFs, silver, and junior explorers often collapse together once broader equity markets seize up. Wall Street markets these products as separate opportunities, but correlation spikes during stress periods destroy that illusion fast. Next, Chris Vermeulen unravels why concentrated conviction trades eventually punish even experienced investors during late cycle bubbles.
But eventually you're going to do it it's going to blow up and then you lose everything. And we have subscribers who have done that. I've done that. I mean, I've blown up 3 accounts. It's easy to make a lot of money when luck is on your side and you go all in and you have this huge move. You feel like you know what you're doing. You're going to do it again. And that's the problem with bad trading habits. People have a bad trading habit. They try to pick a bottom. They nail it because it was a fluke. They make huge money and then they try to do it again and then it doesn't work and they blow things up. And sometimes it takes 10 or 15 years or longer for you to hit that. Your account could be huge. You could be crushing it for years. And then you get on that one big trade, that one big position where you think you know what you're doing. Some black swan event happens and your account blows up. And unfortunately, I see it all the time. There's a lot of people, 50s, 60s, that get on the wrong side. They're betting against the market or they just don't understand position and risk management. And it's going to catch up to you, right? If you aren't disciplined, you don't know exactly what you're doing and you're not comfortable in this market. It's like, we understand the markets and the trends at play. We're very calm and cool and collected, and we have a game plan for everything. No matter what happens in the market, we're never going to blow our account up.
The most dangerous phase of any bull market begins when investors mistake survival for skill. Chris Vermeulen's argument suggests many traders only discover their true risk exposure after one oversized position collides with an unexpected macro shock. That's exactly how decades of gains vanish in a single cycle. despite years of apparent success beforehand. Central banks condition markets to expect endless bailouts, but liquidity disappears much faster once panic finally overrides confidence. Next, Chris Vermeulen reveals why position sizing matters more during bubbles than stock selection itself.
We're never going to take a big hit that's going to change our lifestyle or dramatically hurt ourselves. But most investors and traders are just stringing things on. We've had one of the biggest, strongest waves of growth. Every dip's been bought. You've done exceptionally well, but eventually one of these dips is going to break and it's going to collapse and it's going to take 5 or 10 years to come back. And they're going to be like, wow, I thought I knew what I was doing. And you work your entire life and then one bad mistake or one not taking the proper action destroys everything. So that comes back to your question. Miners and gold and silver are the same trade. If you've got a huge position in it, just know if you lose on one, you're losing on them all. So count that chunk of your portfolio to get slaughtered, right? So that's what people need to be aware of.
Do you think that that is what we're looking at, a dot-com style bubble?
I do. And I hope that's the case, because when we get into a bubble and a euphoric move, it's usually the last thing that happens before we have a big financial reset. And I think financial resets are good. They're healthy. They're painful, obviously, for investors, but it does reset the economy. It resets businesses. It resets all kinds of stuff, right?
Every major bubble convinces investors that this time risk management suddenly became unnecessary. This is where Chris Vermeulen's thesis shifts toward the uncomfortable reality that endless dip buying eventually conditions people to ignore downside entirely. Dot-com investors learned that lesson painfully when years of gains disappeared faster than anyone expected. The same psychology now exists across metals, miners, tech, and leverage-heavy portfolios built around perpetual central bank support. Next, Chris Vermeulen exposes why financial resets historically begin right after confidence becomes nearly universal.
It really is a global reset across the board for business and lifestyles. And the markets are frothy. I mean, they've been going up. We got crazy amounts of printing, which is why it's the perfect storm for commodities and for precious metals to go up. But I do think this is a bubble that is starting to happen. And hopefully we see one last big kind of pop in price that will signal a peak is just around the corner.
Incredibly interesting. I would love to transition shortly to the commodity complex, and specifically the disruptions that we're seeing. For oil, in recent times, we have been seeing a lot of weakness on the back of a potential peace deal. But when I speak to energy experts, it sounds like these disruptions will last for months after a potential reopening of the Strait of Hormuz were to occur. Is right now, on this weakness in oil, a potentially interesting entry?
I don't really want to get involved in the oil space. I am a much more conservative trader. I wouldn't even say really I'm a trader. I'd say more I'm an investor. So I'm not looking for noise. I'm not looking for volatility. If we look at oil, there's no doubt. It's got volatility, huge rally, huge sell-off. It's just all over the place. One day we think, there's going to be a deal and it's done. And then the next day, there's missiles flying. And then it's back and forth. It's been going on this forever. I do think this is going to drag out for a long time.
The Fed keeps warning about inflation while years of money printing continue distorting every major commodity market underneath the surface. Chris Vermeulen notes that bubbles fueled by liquidity injections often end with one final euphoric surge before confidence suddenly fractures. Oil volatility is exposing that instability in real time as geopolitical headlines repeatedly override traditional supply-demand pricing models. Investors chasing every macro headline risk, getting trapped inside noise instead of recognizing broader capital rotation trends already underway.